Welcome to Wealth Wisdom, your destination to build smart money habits and financial freedom. Don't forget to like, share, and subscribe for more financial wisdom every week. Have you ever loaned money to a friend and expected them to return it after a few days with a small thank you gift or interest? That is the simplest way to understand a bond. A bond is a loan. But instead of lending it to a friend, you lend your money to a government, company, or organization. And in return, they promise to pay you back after a certain period with interest. So, why do bonds exist? Imagine a government needs to build roads, schools, or hospitals. Or a company wants to expand its business. Instead of going to the bank, they issue bonds to the public. When you buy a bond, you are lending them your money. And they promise to return your money, called the principal, after a fixed time, called the maturity date, plus interest payments along the way. Let's understand this with a simple example. Suppose the government issues a bond of 10,000 rupees with a 5% interest rate, and the maturity is 5 years. That means, every year, you will get 500 rupees as interest, and after 5 years, you will get back your 10,000 rupees. This yearly interest is called a coupon payment. So basically, you get paid for waiting. Now let's look at some common types of bonds. First, government bonds. These are issued by the national government. In Nepal, they are called development bonds or treasury bills. They are considered very safe because the government is unlikely to default. Second, corporate bonds. Issued by companies. These may give you higher returns, but also come with higher risk. Third, municipal bonds. Issued by local governments to build public services. Not so common in Nepal, but popular in many countries. Fourth, zero-coupon bonds. These don't give yearly interest. But you buy them at a discounted price and get full value at maturity. For example, you pay 8,000 rupees now and receive 10,000 rupees after 5 years. So, why should you invest in bonds? Here are 5 strong reasons. Number 1. Stable income. Bonds provide regular interest. Perfect for retirees or those who want steady returns. Number 2. Low risk. Compared to shares, bonds are less volatile. Great for conservative investors. Number 3. Diversification. Mixing bonds with stocks reduces the risk of losing all your money. Number 4. Liquidity risk. Sometimes, it's hard to sell a bond before maturity. But don't worry, with proper knowledge, you can choose good quality bonds and reduce these risks. So, how do you invest in bonds? In Nepal, you can buy bonds through commercial banks, Nepal Rastra Bank's auction system, stock brokers listed with NEPSE, or mutual funds that invest in bonds. You can even buy government bonds online if you have a demat account. Just like shares, bonds are also listed on the secondary market, and you can buy or sell them anytime. Now let's compare bonds and stocks. Which is better? Bonds and stocks are like tea and coffee, both have their own flavor. Stocks can give higher returns, but also come with more risk. Bonds offer stability and peace of mind. That's why smart investors combine both in their portfolio. This is called asset allocation, and it's the secret of long-term financial success. So finally, should you buy bonds? If you are someone who wants regular income, less stress, and capital safety, bonds are a great choice. Especially in a country like Nepal, where people still depend heavily on land and gold. Investing in bonds can be a new and powerful way to grow your wealth. You don't need lakhs to start, even small amounts can help build a strong financial base. So next time someone says investing is risky, tell them about bonds. If you found this video helpful, please don't forget to like this video, subscribe to Wealth Wisdom and share it with your friends and family. Let's grow our financial knowledge together. Thank you for watching.